What's up guys, Ben here and welcome to Motivation to Invest. Benjamin Graham is the father of value investing and Warren Buffett is his greatest student. Benjamin Graham actually wrote a book back in 1949 called The Intelligent Investor, which Warren Buffett states is the greatest investing book ever written. And here it is. This is an incredible book and it's jam-packed full of investing secrets. However, one major issue with the book is as it was written back in 1949, it can be quite difficult to decipher. So in this video, to help you guys out, I've gone through each and every chapter of this book and read it cover to cover. I then recorded mini vlogs each time I read a chapter over a period of a few weeks. So in this video, I've compiled together my mini vlogs to give you guys a brief overview of The Intelligent Investor, an exceptional book on value investing. So without further ado, let's dive in. Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investment tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on. That way you'll get notified when a great stock is at a great price. So that being said, let's get into the video. Guys, so here we have The Intelligent Investor by Benjamin Graham, written in 1949. So there's 20 chapters that I'm gonna get through. Preface, 4th edition, by Warren Buffett. So let's just briefly read this for you guys. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework you must apply, the emotional discipline. A few key points here. Let's rattle these off for you guys. So a stock is not just a ticker symbol or an electronic brick. It's an ownership in an actual business with an underlying value that does not depend on its share price. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to the optimist and buys from the pessimist. Future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be, No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by investing on what Graham called the margin of safety, never overpaying no matter how exciting an investment seems to be, can minimize your odds of error. The secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with patient confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. Basically, keep your emotions in check. Some lessons here. Book will teach you how you can minimize the odds of suffering irreversible losses, how you can maximize the chances of achieving sustainable gains, how you can control the self-defeating behavior that keeps most investors from reaching their full potential. So yeah, chapter 1 is basically investment versus speculation, results to be expected by the intelligent investor. Definition here. Graham's definition of investing could not be clearer. An investment operation is one which, upon through analysis, promise safety of principal and an adequate return. Note that investing, according to Graham, consists of equally 3 elements. You must thoroughly analyze a company and the soundness of the underlying businesses before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance. That may seem like common sense to just analyze the company before investing into the stock, check the prices, use a margin of safety, and actually understand the business before you invest into it. However, not many people actually do that. Many people spend less time analysing a company to invest into it than they do analysing a type of, say, computer. Shall I buy the new Xbox or the new PlayStation? Which is crazy when you're investing thousands and thousands of pounds into one of these stocks. So that's chapter 1, and I hope that was insightful for you, just to give you a brief overview of the principles. Saves you guys reading it. On to chapter 2, we have investor and inflation. So this chapter basically looks at the amount of inflation which happens over a period of time, which basically affects the value of goods and the value of your cash. So there's some great examples in here, and I'll go over them now. The first thing we notice is that we have had inflation in the past, lots of it. The largest 5-year dose was between 1915 and 1920, when the cost of living nearly doubled. Companies with the advance of 15% between 1965 and 1970. In between, we have 3 periods of declining prices and then 6 advances of varying rates, some rather small. On showing this, the investor should clearly allow for the probability of continuing or recurring inflation to come. Some hedges against inflation are REITs or real estate investment trusts, which are bundled into real estate mutual funds, allows you to invest into property. You've also got TIPS, Treasury, inflation protected securities. So guys, I've just read through chapter 3, a century of stock market history, the level of stock price in the early 1972. My basic summary of this chapter is that you should always be mindful when the market is overvalued. So a great philosophy I use for this is observe the masses and do the opposite. So if the market has been rising for the past 5 years, 10 years, as it did between the years of 2009 up until 2019, then you should be more cautious, not less cautious. Yeah? As a crash may be coming, because the market fluctuates between 2 extremes, either very, very optimistic or very, very pessimistic. So you need to be mindful of that. A great example in the book is, it basically showed that when the PE ratio, the price to earnings ratio of stocks were high in the past, this historically produced lower earnings in terms of stock prices in the subsequent years. Another example is the dot-com bubble, where there's a lot of exuberance, a lot of money flowing into lots of businesses, and then the dot-com bubble happened and the stock market lost over 50% of its value, which is a massive amount, especially if that was your savings in that. On the contrary side though, when there has been a market crash and the stock market valuations are very low, then that is when you should really be bullish on the market and you should be investing. This is the true contrarian approach. Right guys, on to chapter 4. This is all about stocks and bonds. So yeah, in chapter 4, basically Benjamin Graham discusses the portion of your portfolio which you should have in terms of stocks and bonds. So he suggests that those with a higher risk tolerance should have 75% of their portfolio in stocks and 25% in bonds, and those with a lower risk tolerance should have more, obviously, bonds in the portfolio with a minimum of 25% stocks. Now this all depends upon your personal financial situation and even your age and the amount of money you've got to cover your lifestyle. So generally, if you're closer to retirement and you may need to live off the income, such as a dividend income, investment income, then you're much safer having more of your investment portfolio into bonds. However, if you're a younger investor, say 20s, 30s, and you think you will not need to touch the money for a while, or even if you're older, if you're in your 40s and 50s and you think, well, I've got income to live off and I've got savings like a rainy day fund, then you can still invest a lot more into stocks. Now, a 50-50 is a common approach, 50% stocks, 50% bonds. Benjamin Graham also suggests that you can have 100% of your portfolio in stocks under the following circumstances. So during the previous market crash, if you've had an investment portfolio and you didn't sell everything off and you've got that emotional stability, then he suggests that you could have 100% of your portfolio in stocks. But you've got to know yourself and know if you're the type of person who will sell when it's low, when the goal is buy low, sell high. It sounds obvious, but so many people, and the majority of people, will still do the opposite. And when the news is negative and they say the world's going to end, people want to sell out and sell the stocks. It's just, you got to know yourself and know your goals. Another interesting thing that Benjamin Graham mentions in this chapter is preferred stocks. And he basically said, avoid those at all costs. He says they should be likened to a unrefrigerated dead fish, I think he said. Basically because you get less priority than a bondholder, but you also get less returns than a stockholder. So it's the sort of worst of both worlds. All right, guys, so I've just read chapter 5, the defensive investor and common stocks. So in this chapter, Benjamin Graham discusses some aspects of being a defensive investor compared to more of an enterprising or active investor who invests in more growth stocks. So as a general defensive investor, you want to be well diversified with at least 10 stocks in your portfolio. You also want to invest in companies which are large, well established, and conservatively financed. In other words, they have low debt. Another factor which you need to look out for is their dividend payments have been rising over the past, say, 10 years. Now, that is one of the points that Benjamin Graham mentioned in this book. However, I notice a lot of companies these days don't actually pay a dividend. So you've got to take that with a pinch of salt these days. I believe so, unless you're a pure dividend investor and you want that dividend income to live on. In terms of growth stocks, they can offer higher rewards, but he says basically be cautious with these and still look for those with lower valuations if possible. Another interesting factor in chapter 5 is that of dollar cost averaging. So this is basically setting aside a small portion of your paycheck every month and dollar costing into the stock market. So say you earn $2,000 a month, £2,000, wherever that may be, and let's say you put £500, $500 automatically, and you invest that into an index fund, let's say the S&P 500, the top 500 largest market cap companies in the USA. So that's automatically investing into the businesses and into the stock market. Now, there have been a lot of studies on whether that is better than lump sum investing. Now, in this book, there's a study which stated that it offers much greater returns than any other form of investing. So it states dollar cost averaging is the perfect one for you. I also have done another video on this discussing the differences between lump sum and dollar cost averaging. And from modern research, it turns out that lump sum averaging is actually better if you already have the lump sum, because you want to be in the market for as long as possible. However, dollar cost averaging is better if you don't have that lump sum saved up. But this should all be taken with a pinch of salt. Like, let's say you have £50,000, £50,000 saved up. I'm not suggesting that as a lump sum investor you put all that in one day, but you could put it in, say, larger lump sums of, say, 10,000 each section, or 5,000, depending on how conservative you want to be. The risk is obviously if the market drops just after you invested, then you will see losses, and that's where lump sum investing comes in. So with lump sum investing, with dollar cost averaging, if the market is dropping as you're investing into it, then you actually get the shares at cheaper and cheaper prices. So that's just something to look out for. Check the video in the link below with regards to lump sum versus dollar cost, and I'll get on to the next chapter. So which of Benjamin Graham's value investing principles resonated the most with you? Comment your thoughts below and I'll join in the discussion. In addition, if you enjoyed this video, go ahead, smash that like button for the YouTube algorithm. And if you'd like more stock market investing tips and exclusive stock picks, which I personally have invested into, then you should definitely subscribe to this channel. And with that being said, I will see you guys on the next video. Invest safe.